Hello, my name's Andrew Tang. I'm a strategist at Morgans. I'm joined here with our chief economist, Michael Knox, to talk about central bank policy around the world. Volatility in asset markets around the world is increasingly being driven by central bank policy and central bank action. In what's likely to be another couple of turbulent months for the world economy, we're here to talk about all things economics with Michael. So Michael, thank you very much for your time.
Good to talk to you, Andrew.
Now, the RBA has cut interest rates last week. The inflation number was well below the 2 to 3% target band. I'm just wondering if we could get your thoughts on where you think domestic interest rates are likely to go, how much lower, and what the implications are for the Australian economy.
Well, yeah, absolutely correct. Inflation is what is important, and the inflation number, the core inflation number at 1.7% in terms of the trimmed mean, came in well below market expectations. Not only was the year-on-year number low, but the quarterly number was especially low. For the quarter, that core inflation number increased by only 0.2 of 1%. If you multiply that by 4, that's an annualised core inflation rate of 0.8. That's amazingly low. So the RBA reacted to that by cutting rates by 25 basis points. Our model shows that really they could have given us a 50 basis point rate cut. So we think that if that level of year-on-year core inflation is maintained in the next quarterly CPI, which is the June CPI, which is released in July, then in August the RBA will cut again, providing another 25 basis point rate cut. The question then is there going to be another rate cut after that? And really that depends entirely upon where that core inflation number comes in. If the core inflation number next time around comes out even lower than the 1.7% year-on-year rate, then we're very likely to get a further rate cut later in the year. If it's still at the same level at 1.7, one more rate cut is all we're going to get.
Thank you, Michael. Now, taking a different look, moving outside now, the US monetary policy seems to be moving in quite a different direction from us domestically. Now, we did get a reasonably weak payrolls number last week. Whether or not that has changed your thinking as to the direction or the pace, the trajectory of US rate rises, has that changed your mind at all? Is the Fed looking at other indicators perhaps?
Well, what the Fed has told us in its summary of economic projections, which is the dot diagram that you see released by the Fed every quarter, is that we can expect 2 rate hikes this year. And I've previously thought that those 2 rate hikes rather logically would be 6 months apart. One in June and the next in December. The market has moved to the view that we'll have, instead of a rate hike in June, we'll have it in September and then December. To me, that would surprise me if the Fed did that. There are 2 reasons that would surprise me. Firstly, that September is just before the November presidential election, so you're interfering in the political process. But more importantly, what's actually been happening in core inflation in the US. Since the Fed increased rates in December by 25 basis points, the core inflation rate has actually gone up by 23 basis points. So that means the increase in the real short rate, which is what the Fed thinks it's moving, has only gone up by 3 basis points. In short, there has been almost no tightening at all in the real short rate. And I think what will happen is, I think the Fed, when it says it's looking at the data, I think it's looking at inflation and I think it's looking at not employment but unemployment. Unemployment is still about the same, so you've got the same upward pressure on prices as before, and inflation has gone up by 25 basis points. So I think the rational response by that to the Fed is to hike rates in June. And I think that will be a significant surprise to the market when they do that, and that could generate a little bit of turmoil in the stock market when they do what they said they were going to do in the first place. It's kind of like we have a risk item here which is hiding in plain sight.
So in the short term, Michael, does that imply that we may see some risk in the June meeting up until that point for the equity market?
Well, I think that what would then be a complete surprise hike in June, a generator sell-off in equities leading into the third quarter. And the week after that, we've got the Brexit vote, which Bank of England Governor Mark Carney has now added a little bit of hot sauce to by talking about the increase of a financial shock if Britain left the European Union. So you've got two risk items together. Firstly, the Fed meeting, and then Brexit, and then of course our own federal election directly after that. So these are three reasons in a row why while investors might stand out of the market while these are happening.
Thank you very much, Michael. Thank you for your time today.
Thank you, Andrew.
Appreciate it. And we'll see you again next month. Thank you very much.